Hello, it's Craig Tapping from Mastering the Markets. Today I thought I would take you through a bit of a look at the Australia bonds, the yields, what the RBA has been doing, what's happened to the average Australian mortgage rate, and how that's impacted housing prices over the past sort of 8 years in Australia. Then I was going to take you through the Australian market, what I'm seeing in terms of the XJO, the all ordinary, the top 200 stocks in the ASX, and look at what type of correction we could expect if we do get a big correction in the US market. So we know that the US markets are really toppy at the moment. The S&P 500 and the Nasdaq are up well over 100% since their October 2022 lows. And what we need to look at is what type of impact, if the US markets have a correction, what type of impact will that give us in Australia? So I'm going to take you through a few charts. The first chart that I'm going to talk to is the chart that I've got up in front of you here. And I know it's quite busy, but what I'm going to talk you through a few elements of it. These three lines, the blue line, the red line, the green line, are the Australian government bond yields. And what we have seen is since we had the big inflation problem that stemmed out of the COVID support. So, we were at all-time lows on interest rates back in COVID period. And what we got to when we had so much stimulus in terms of the COVID support, we got to see inflation running really, really hot. And inflation sort of peaked out at 7%. And what we had to do is we had to hike up interest rates. And what tells us what's going to happen is the bond yields. The bond yields is the market's way of pricing in interest rate changes. It's pretty much telling us what the market expects as a return for investing money based on inflation expectations. So that is divided across short-term, medium-term, and long-term bonds. And the three that I like to track is the blue one, which is the 2 year, the 10-year is the red one, and the 30-year is the green one. The long term tells us if there's more of a systemic issue, a bigger issue, and the short term, the 2 year, is very much is indicative of what the RBA are going to do with interest rates. So the little Australian interest rates I've got over here is the RBA cash rate. That is the rate that they give to banks. Then that gets passed on to us as the consumer, the mortgage holders. That gets passed on with this purple line. And the purple line is your Australian mortgage rate. And yes, you can sort of negotiate a little bit higher, or well, hopefully not higher, but you can negotiate a little bit lower in terms of rates. So the passing Australian mortgage rate is currently 6.2. And you probably find that if you look at what you're on 5.7, 5.9%, 6%, slightly below what the going rate is. So when we start to look at what dictates this is the interest and inflation really does dictate what interest rates need to do. So the higher inflation goes, the RBA has only interest rates to really put up interest rates. They cut demand, and when demand decreases, inflation increases. So if you think about it, you have a pool of money. If interest rates are low, you're not spending that much servicing your mortgage and servicing your credit and debt and everything else. And what you have is you have more spending power. You're going and spending more on entertainment and food and the discretionary spend in shops. When mortgage rates go up, it takes a huge amount of your disposable cash out of your pocket. And that creates a downward pressure on inflation because demand is reduced because people are spending less. And when demand reduces, that supply versus demand imbalance rectifies itself and inflation tends to come down. So what we look at and what I've got on here and the interesting things to see is since the war started, we've certainly seen that bond yields have started to rise again. And bond yields now have broken through where they were. So the 30-year yield was sitting at 5.1% back in 2023, and that was after all of our interest rates went high, and our interest rates were at the highest point that they've been in many years. And what we can see now is the 30-year bond yield has actually, since the war started, has broken through that 5.1% that it was sitting at the 2023 top, and it's actually sitting at 5.5, which is getting a little bit scary. And what that does is the higher the bond yields go, the more risk there is in the markets. When we look at the 10-year yield, it had topped at 4.7% back in 2023. It's now once again broken through that resistance and made a new high, almost touching 5%, 4.97%. And when we look at the 2-year yield, which really determines what the central banks, what the RBA uses to guide their interest rate, we were topped out at 4.3% back in 2023, and we actually headed up to 4.8, but we've actually have softened a little bit with a few better CPI reads and the price of oil dropping back from 100 back into the 80s. We've come back and we're sitting at 4.55%. So what the yields are telling us is there's a chance that we'll get another 0.25% rate hike by the RBA. And what we want to see is we want to see this 2-year come down under the RBA rate of 4.35 to take away the risk of seeing another interest rate hike. So that's what we're looking at, and this is what the mortgage rate is at the moment. The interesting thing is what impact the mortgage rate has on housing prices within Australia. And what you can see is when we were high interest rates back in that sort of 2015 to 2018 period, what we could see is the housing prices, the average housing price in Australia was sitting at between that 690 and actually dropped down to about 650K just before COVID. And what we saw between 2017 and 2019 was prices in Australia actually coming down by about 6% over the 2 years. Then what happened is we had COVID, and COVID stalled property prices, and there was a little bit of a dip through COVID. So straight after COVID, there was a bit of a dip. The houses weren't selling. And then what happened is a few months after COVID, I think it was January the following year, we started to see houses going absolutely berserk. Auctions were going through the roof. House inspections had heaps and heaps of people lining up at the door. There were sellers that were taking 5, 6, 7 offers on a place in their very first open house, their first house inspection. So things went absolutely berserk. And in that period, 2021, 2022 mainly, we saw a 44% jump in the average housing price in Australia. And we went from an average of where we were in 2019 at 650K average selling price to 940,000 being the average price of all the property sold at the end of 2022. Then what we went, 2021. Then what we went through in 22 and 23 is we went through the rate hikes. And the rate hikes put a damper on selling prices. It really capped it. And when people have to service mortgages with much higher interest rates, and we were down at 2% interest rates down here, a lot of people had locked in at 1.9, 1.95% back in 2021. And what happened is in 22, 23, those mortgage rates went from 2% to 6%. And in the beginning of 2023, it went up to 6.8%. And that put a huge amount of strain on the housing prices in Australia. And it really kept, we ranged for 2 years, 2023 and 2022 and 2023, housing prices ranged between that 890 and 830K. So when we start to look at what has happened since is in 2024 and 2025, what we actually had is we had a few rate cuts, and the rate cuts allowed the housing prices to escalate once again. And what we saw in 24, 25 and into the beginning of 26, we actually saw a 25% increase in the average housing price. So we actually went from 880K average house sold in Australia at the beginning of 2024 to where we were just before we started rate hikes again in January this year. We had a 25% increase in price. The average Australian home was selling for 1.1 million. Now we've started the rate hiking cycle again, or we've had 3 hikes, and it's really going to be interesting to see what happens to the average prices. Now, what we can see from the data over the past few weeks and the past few months, which hasn't really flowed through to the quarterly updates. This price only sort of updates quarterly, and the last quarterly update we had was March. So probably by the end of this month, we'll get the Q2, which is the end of June quarterly update. And that's probably the first time we'll see that the average housing prices started to drop again because of the high interest rates, and that's the pressure. We've also got the addition of the capital gains tax and and the impact on investment properties in terms of negative gearing falling away, which will also have a significant impact on Australian housing prices. So that's a little bit of a take on Australian housing prices. Looking at the Australian stock market, what I'm seeing here is, from the COVID lows, we always look at bull markets and bull cycles, and primary trends in markets happen in three phases. And what we talk about those three phases, Dow Theory calls them the accumulation, the public participation, and the excess phase. And where we look at how we've gone is we had this massive sort of recovery, V-shaped recovery out of COVID, which would be our first phase. And, that was the 2020, 2021 bull market that was fueled a lot by a lot of stimulus in the market and a lot of money printing. What we got after that was the 2022 pullback. That pullback coincided with the rate hikes that we saw in 2022 into the beginning of 2023. And then what we got was we didn't get the big bull market that the US got. We got a reasonable bull market, but it wasn't driven by the big tech rally that we've seen in the US through the dynamic RAM and the semiconductors and all that sort of computer hardware that's gone absolutely berserk. So we don't have a lot of that in Australia. In Australia, our markets are mostly financials. The big banks are really important. And then resources and materials is really big for us. And those didn't really fly really hard until we got the rally in 2025. And you can see that V-shaped recovery, which was the sort of like the last blow-off phase of the public participation that we had. And, that was fueled by small caps that we started rate cuts in 2025, which really fueled the small caps and also fueled that gold and silver rally. So when we start rate cuts, but we don't see the growth yet, that's when precious metals run really, really hard. And we certainly saw that. Since October last year, what we've seen, the period that we've been in, has not felt like a bull market. It hasn't felt like a bear market. It's been what we call a kangaroo style market. And there's a really good reason for that. So because we're not really in the cutting, so we're not fueling a bull market, and we're not really raising rates aggressively, so we're not really in a bear market like we were in 2022. We're sort of indecisive in terms of, are we tightening? Are we expanding? Where are we sitting with central banks? And obviously the war that's happening between the US and Iran is adding a lot of confusion to the markets as well. So what we can see is we're in this sort of kangaroo style market. And I'm not going to go through Elliott wave counts with you, but what I am expecting is I'm expecting three phases of this correction. And this was the first phase, and that was completed. And this is the second phase, which is the recovery. And my target was for the XJO, the top 200 stocks, to go between 9160 and 9444. And we're in that zone now. And then I am looking for a third phase. And a third phase takes us back to the lows that we were back in March earlier this year. And we could potentially take out that low and go a little bit lower. So once this correction is finished in terms of the three phases, then we open up the opportunity to have the final phase of the bull market, which, we had the 2021 and we had a 22 correction. We got the 23, 24, 25 pump, and we sort of got this 26 choppiness. And then we potentially have a 27, 28 move into what we call the excess phase, and where I expect us to go higher. So the big question we've got is, if we're going to have a pullback over the next 3 months, 6 months, 9 months, 12 months, whenever it happens, we don't quite know the timing of the correction, but we know that a correction is likely, specifically in the US markets. And we all know that when the US sneezes, global markets around the world catch a cold. So if the US markets do have a big correction, this is potentially what we could expect. So the next step is, what is safe? Where do we want to invest? So if we are worried about a correction, which sectors do we regard as being safe to invest in, and which sectors are likely to get hit the hardest if and when we have this type of correction? So when we go to the sector performance and we go back to 2022, because if you think about this correction is going to be 30 to 50%, maybe 20%, 30%, 50%, correcting the gains that were made since the end of 2022. So what we want to see is which sectors have given us gains between the end of 2022 and now, and which ones will have to correct 20, 30, 40% of those gains. So when we start to look at the sector performance from late 2022, when the bull market started, we can see there's a couple of things. Firstly, healthcare has had a massive, massive sell-off. And since the bull market started, healthcare is down 29%, which is why Dave and myself and a whole lot of people from the Master in the Markets community are looking at potential healthcare stocks because they have corrected hard. They don't need to correct anymore. So if you think about the reason that things correct is they correct and retrace some of their gains. But if you haven't gained, you've got nothing to correct. So the three biggest opportunities, the three sectors that haven't actually put in gains back from 2022 over the last 4 years has been healthcare, which is down 29%, energy, even though we've had the really big pump of energy, in the bigger scheme of things from 2022, we have actually only shown a 4% growth in the energy sector from the bottom of the last bear market. So we don't really have to correct energy because we're only up 4% in 4 years. And the other one is consumer staples, where we're only up 8% in 4 years. So the correction needs here on these three sectors are minimal. Some of the things that could need to correct is materials, and that's been led by that gold and silver rally. And if you caught my video last week, I spoke about gold and silver, and a lot of people think that the macro low is in and we're going to all-time highs now. The economic conditions may not align to new all-time highs now on precious metals. We still got elevated rates, and precious metals don't like those elevated rates. So materials is up 60%. So potentially that could lose 1/3 of that. Financials is up 56%, and with interest rates really high, banks aren't issuing new loans. Not many people are going into the bank and asking for loans at 6.5% interest rates. So what you can see is financials and materials potentially aren't the areas where we would expect a lot of new business. When we look at consumer discretionary has run fairly hard between 2022 and now. That's up 54%, so that could have a bit of a pullback. Technology was up 122%. And what we actually saw with technology is we saw a really big correction. And it's now having a bit of a recovery bounce, but it's still up 44. So it probably has one last leg of a correction left. So tech, you would just be a little bit cautious, especially if the US stock market has a big pullback, and that pullback is led by tech stock sell-off. That will impact our technology as well. Industrials up 42%, so could lose half of that. Property up 37%, could lose half of that. Telco sitting at about 20% up, not too much of a risk. But if you wanted to park money into safer sectors, my sectors of choice for if I wanted to be more defensive, expecting a bit of a correction, would be consumer staples, energy, and healthcare.